Okay, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we want to talk about thoughtful portfolio construction and what goes into an overall portfolio beyond traditional stocks and bonds. We know that investors need exposure to different sources of return and risk. And one area that we find particularly interesting, and we've been getting questions about, is how do we get exposure to private markets? And, specifically, we want transparent, we want good information regarding the private markets. And we've been looking at different types of equity exposures through different structures and have found private shares. In fact, private shares, we started observing private shares back as far as 2014 when they first came out with their A shares. And then they came out with their institutional funds. And we eventually decided that we wanted to have private shares in all of our portfolios or most of our portfolios. There are some interesting developments around the private share fund that we're using today. And Steve and I decided that we wanted to bring in David Gutierrez, who is the Vice President of Private Shares, and JP Sullivan, in charge of distribution from the private share team. And we wanted to walk them through some questions and just get a general feeling about what they're seeing. So, JP and David, thank you so much for joining us. Let's start by helping our audience understand what kind of private equity exposure this fund actually is. And so, Steve, do you want to start with the questions?
Sure. So can you walk us through the types of private equity that you focus on and just help our audience understand how it differs from what people typically think of when they think of private equity?
Yeah, absolutely. And it's great to be here chatting with you guys. I think it's kind of a perfect place to start. And JP just pulled up kind of a slide that shows our current holdings. So, private markets have obviously grown a lot over the last handful of years and even beyond that. And a part of that growth has been an expansion of the private equity asset class as a whole beyond kind of the traditional segment that you think of with PE, which is buyout, right? More mature companies, a lot of times already public, who get acquired, maybe taken private, and are trying to run a little bit differently by their private equity sponsors. So part of that expansion, part of the categories that have seen a lot more capital flow and increased interest these days is venture capital, right? VC historically has been comprised of early stage companies either trying to disrupt existing companies in their market segment, or in a lot of cases, trying to create new industries altogether. But kind of similar to what's happened with private equity as a whole, as more capital has flown into VC, it's allowed companies to, one, stay private for far longer, and has expanded the segment to include new areas like where the private shares fund spends all of its time, which is in the late stage venture and growth equity space. So just to provide a little bit of clarity on how that differs from traditional VC, the companies in our segment are not the early stage companies that are still building their first version of their product or out trying to win their first handful of customers. It's quite the opposite in most cases. The companies in our universe are generating hundreds of millions or even billions of dollars in revenue and are focused on kind of scaling a well-running operation rather than building a foundation on which they plan to scale later. So, just to kind of point out a few things in our portfolio, the median revenue is kind of above $200 million, and about a third of our companies are profitable. So really just metrics you wouldn't ever see in the early stage, more traditional venture part of the landscape. And I think speaks to kind of the quality and maturity of the types of companies that we're investing in.
Wonderful. Yes. And that's that whole structure is part of what we really were going after. In fact, the structure of the fund is a big differentiator. Advisors are used to traditional closed-end or drawdown vehicles. Can you explain how the fund is structurally different, and particular how the institutional class is advantageous to our clients, from a cost perspective as well as an access perspective?
Yeah, maybe explain drawdown also for our audience.
Sure. Yeah, Laura, I'll take that. And thank you again for having us on here. No, you're 100% right. Historically, the way investors were able to basically access really any private investment, whether it was VC or buyout, for that matter, that David just walked through, was through the traditional private equity drawdown vehicle. right? And you can see that in the light gray on the left-hand side of your screen. There's typically investor qualifications for those types of vehicles where you'd have to be a qualified purchaser, which, as you know, but maybe the audience may not know, you would need $5 million of liquid net worth just to access these sort of investments, right? So it's not including your house and total net worth. This is just liquid net worth. And then it usually would come with very high minimums of $250,000 or more. Some maybe investors that you have are maybe familiar with this, where they would get 60-page sub-document agreements and have to go through all of that literature and sign, several pages and then submit those documents to the fund provider. And that could be, quite a headache just to try to wrap your head around all of that information. And it's also very much a challenge at the advisor level to provide these sort of, investments to an entire client base. So,
Right.
that is another kind of the other aspect of it. Usually these funds have lives of 7 to 10 years where you're not able to touch that investment for a decade in a lot of cases. And what we've actually even seen over the last several years as IPO and M&A markets were really quiet, where these sort of investments would get full liquidity, right? Is that those 10-year funds actually become 11, 12, or 13-year funds, which is another, could be a challenge. And there's usually 2 and 20 fees, right? So a 2% management fee. And the GP or the general partner of who's running this private fund would then ask or agree to with the investor a performance fee with some sort of hurdle, right? They need to provide you a 7% return. Anything beyond 7%, they're going to claw back, 20% of that performance beyond that.
Gain.
So it's it can be a bit of a challenge for advisors to easily access this for all clients, and there's definitely different nuances and operational headaches that can come alongside a traditional drawdown vehicle, right? So what our fund provides is it really mitigates a lot of those issues that we just discussed. It's categorized as a 40 Act interval fund. So it actually falls under the same legislation of a traditional mutual fund, where we have a simple ticker symbol. It's no accreditation requirement. So every single investor, regardless of net worth or liquid net worth, can access this fund. It's a $2,500 minimum, so not $250,000 or more. There is no sub documents, and it basically top to bottom would work and look and feel like a mutual fund in almost every component. The important distinction is that we offer quarterly liquidity, which is subject to 5% of the total fund's assets on a given quarter, which is still very much more, better than a 7 or 10-year lockup. Right? So you have a quarterly liquidity feature as compared to a 7 or 10-year lockup. And what Laura was alluding to earlier in terms of the iShare being available for her client base is that this fund can only be purchased through an advisor team, right? So you have to have a relationship with a financial advisor to seamlessly access this fund through an iShare, which is PIIVX. And that is the most cost-effective way to access this fund. If you're a simple investor that has an account, let's say at Fidelity or Schwab or E-Trade or whatever platform you may have, you actually can't purchase this fund on that platform. And it's designed that way so that, our quarterly liquidity feature is somewhat intact to the best of our ability, because financial advisors will completely understand how this fund works. So I'll pause there. I think it just simply.
I think
the
main thing about the having that quarterly redemption is, I really think it's very important for investors to understand, for our clients to understand, that you don't want people going in and out of that fund willy-nilly, because it's going to create a lot of trouble for our portfolio
David.
managers, for David to go to actually
Yeah.
maintain the right kind of structure in the
Correct.
portfolio. I also want to say that when you somebody that can get into an A share, there is that front load that can make it
Right.
somewhat front
Right.
load, and also the marketing fees, the 12B1 fees that make it somewhat more expensive, sometimes even cost prohibitive. And you can get an iShare, I guess, if you have $1 million, or if you're working with an institution or an advisor like us. Am I correct by saying that?
That is absolutely correct. Yes.
I want to mention one other issue is with the traditional equity fund, you're going to get a K1, which is going to complicate your
Oh,
taxes
yeah.
as well. So you may not even be able to file until October, because a lot of times the K1s are corrected 2 or 3 times, and you may not
But
have the final until August or September.
we're
Whereas with
not
the
even
40,
considering the traditional private funds for
no,
like
no,
I mean, there's 1 or 2 clients that might be appropriate for that,
right,
them.
right.
For the average client, we want our
Their
clients
money,
to
if
have
they-
access to decide that they want to, there's changes in their lives, whatever, they should have access to it. We don't
You don't
want
have
it
that
to be locked up
liquidity.
for 10 years, 12 years.
Right.
That's
Absolutely.
Right.
crazy.
And I just want to make sure with the private shares, you get a 1099, there's no K1, which is
Yep.
important.
Correct.
Okay. So I guess next, you can explain to us how you actually choose which companies are in the fund. How they and what criteria you use to prioritize them when you're looking at opportunities.
Yeah, great question. I think it kind of to maybe pull it apart into 2 pieces, right? There's kind of the selection, and then there's the sourcing of how we're finding the deals that we're investing in. So I'll start with sourcing, as that's kind of the top of the funnel. One thing to note about us, we're passive investors, right? We are not writing massive checks, getting involved in governance or the operations of our portfolio companies. And so as a result of being passive, one of the things that we always look for, and kind of a thing that starts our sourcing and research process, is looking for the presence of high quality institutional venture firms like the ones you see here on the slide. So, you see right there, we share about over 50% of our portfolio companies with leading firms across Silicon Valley, Excel Partners, Andreessen Horowitz, Sequoia, Founders Fund. You guys see the list. So we
Yep.
really pride ourselves in investing alongside some of the best investors, and use their presence in these companies as a sign that there are the right kind of institutional folks on the board, and helping these companies to navigate through the things that you will navigate as a growing private firm. But
And these are the
more-
right names.
yeah,
These are the big names. But David, I do want to just say, because you guys do this all the time. I do want to, when David says that we're passive, they're not passive in terms of the actual selections. They're passive in terms of
right.
the operations of the business. So
Right.
if you invest in with a venture capitalist group, or they actually sit on the board and they get involved in selecting um, the human capital and doing all kinds of things. And that's really, you don't do that, but you're very involved in the selection process alongside with them.
Correct. We actively manage the portfolio, but we are not actively involved in managing the companies themselves.
Right.
I think that's a really good, important distinction. Thank you for kind of
Yeah, it
drawing
is.
that.
It is.
But we'll use, so basically on a very regular basis, weekly or monthly, we are monitoring all the deals that these firms and others that we deem to be really high quality are doing, not just in our part of the market at the later stage, but all the way at the very earliest stages of the market through to where we are. So we see pretty much everything that these leading firms are doing, and that kind of gives us 2 really key important insights. One, it allows us to see where these firms who are spanning every stage of the venture capital ecosystem are placing their early stage bets. And that provides us of early indications of new emerging product categories, potential breakout companies at earlier stages. And piggybacking off of that, when we do see things that say, hey, this is a really exciting space, or this company has a few of these investors investing very early, it allows us to then start developing direct relationships with these most compelling early stage startups well before they arrive at our investment window. And so, we're in an incredibly competitive business, and the earlier that we can start to build these relationships with companies and provide value to them, whether through introductions to other companies that we know, or really anything that they may need, the more well positioned we're going to be to do a deal when they inevitably do grow to the point where they're now in that later stage part of the market. So that's kind of how we keep track of the universe of companies. And then in addition to that, we've been running the fund for about 12 years now, and over that time have built a really strong network of relationships across Silicon Valley, whether that's with investors. We've had obviously 60 plus exits where a lot of people who, were executives at previous portfolio companies go to work at new, very exciting private companies. And then, capital markets teams at all of the major investment banks. And so we stay in close contact with all of those different parties. And those have been also a really important part of us seeing deals and having access to high quality deal flow. I can stop there, or I can kind of talk a little bit more about how we select once we kind of know where we're looking.
Um, but
Yeah.
maybe that actually could come up in this next question that I have, which is,
Yeah.
diversification is one of our favorite words. We love it. And we want to know really how deliberate the fund's approaches to sector diversification and how you think about balancing exposure across industries, which might get into that whole piece as well.
Yeah, absolutely. So we're pretty well diversified fund. Our aim in building the portfolio is to offer our investors a well diversified exposure to the leading companies in late stage venture. So you can see here 21 different sectors covered. And I think it's important though to kind of know two things. One, very broad diversification, but within that too, we want to also focus our efforts on the sectors that we believe are going to be the major drivers of returns in the asset class. So our goal is not simply to just be an equal weighted index of every single sector where VC dollars have been invested. As I mentioned, it's to provide our investors with exposure to what we think are the leading companies in the private markets. And at times, as you can see here, that may mean that we skew a little more heavily towards a smaller group of sectors if we think that those sectors are experiencing really outsized tailwinds relative to the rest of the sectors that we typically look at. So if you look at kind of the slide, right, our top three sectors: aerospace, finance, payments, and analytics, big data, and AI too, I guess, are I think roughly about 50% of the net asset value. This is somewhat skewed due to our quite large position in SpaceX, but we think it does provide a good illustration of how the best way to diversify in the private markets and late stage venture is, which is broad exposure to the entire universe with focused exposure and concentration in certain sectors where there are just obviously outsized tailwinds, being supporting in those areas.
Great.
Some of your recent acquisitions have been in the defense area, so that's kind of rising, right?
That's a new sector that we have been focused on understanding for quite a while. I think, compared to other sectors where you're selling, B2B or a private sector to private sector, there's a lot of differences both from the go-to-market and sales motion perspective, as well as just general regulatory perspective that you need to understand to be, investing in defense properly. And so I would say over the last, 12 to 16, 18 months, we were really doing a lot of that early legwork, building relationships across that part of the market, understanding how products get bought and sold in the Department of Defense, and really building that network that we've built in other sectors. And yeah, we've been excited to make a few, I think two investments so far in defense, and that's not quite shown up. Oh, actually, yeah, there it is. Two investments in defense recently, and we expect that to be, again, another sector that is experiencing just really massive tailwinds given all of kind of the geopolitical volatility. And so expect that to climb up this list here over time.
Yeah.
Well, they're
And
proposing
okay,
a large increase in the defense budget for next at least year, if not more. So I
Yeah.
think it's probably a good place to be.
it's interesting, right? So for our clients who know Steve and I as being rather conservative investors, this is the sexy part of your portfolio, where we're actually getting involved in some of the cutting edge, interesting areas.
Yeah. So can you highlight some of the actual individual holdings and that have been meaningful contributors to the portfolio, and what made those companies stand out?
Yeah, absolutely. I think, it would only make sense to start with SpaceX. It's the biggest position in the fund. It's one of our longest holds as well. And really at this point, a company that kind of needs no introduction, right? I think They've really redefined what it means to be a private company, kind of created an entirely new industry, as I alluded to earlier, in commercial space, and kind of pioneered this new way to create a public-private partnership to really go after the development of critical capabilities. So just for anybody who's not super aware, right, they operate at three kind of areas. One is launch
Yeah.
services, where they're the leader globally. The second is satellite communications with Starlink, their satellite constellation and broadband business, and then following their recent acquisition of XAI, branching out into artificial intelligence as well. But as I mentioned, it's been a major winner for us over the 7 to 8 year holding period that we've had it in the fund. At the time of the initial investment, it was kind of the only scaled private launch provider available to invest in, which we saw as a standalone business as extremely attractive in its own right, and with the potential to get very, very large. One of the other things that we saw at that time was kind of the optionality that being a launch provider gave SpaceX to get into other adjacent businesses. And I think, the growth of Starlink has really been kind of a proof point in that thesis, that because they were able to launch their own satellites, they could start their own satellite constellation business for a much lower cost than somebody who did not have that kind of a capability. And Elon has talked a lot about things like data centers in space recently, which
Right.
Is getting
Right.
more and more public attention. And I think they really have a right to win in that industry, again, on the back of the ability to really launch their own product that no other competitor really has. So that was what attracted us to SpaceX at the beginning. I think we've been incredibly proud to be involved in such an exciting and kind of transformational company well before it was quite the household name that it is now, and are definitely excited for, obviously all the news that's been coming out about them potentially going public sometime this year. So that's one that's been a big driver for quite a while. A second one that I'm very close to and is near and dear to my heart, is a company called Cerebras.
Hmm.
They are an accelerated computing company, so they build semiconductors, and they build the world's largest semiconductors to eliminate and overcome a lot of the delays that you encounter using kind of traditional systems like those you might find from
Right.
NVIDIA or another traditional chip provider. Over the last few years, when we invested, they were kind of a small niche hardware provider. And over the time, I think beginning of 2022, when we made our first investment, they've really grown into a full-fledged kind of AI infrastructure business that's working with countries around the globe to power their own, local AI initiatives, as well as, even just right here in the US, critical partners like Amazon and OpenAI, really showing kind of the quality and growth that they've experienced over our holding period. So,
Yeah.
on this one, what kind of stood out to us, investing, early 2022, about 10 months before ChatGPT had been released to the public and started the firestorm that we're all going through now with AI.
Yeah.
The company was just so clear around the problem that they were setting out to solve, and they had taken such an original approach to building a chip that was really uncomparable to anything else in the market. Their chip is the size of a dinner plate, whereas an NVIDIA chip.
That's what I heard.
Yeah, it's
Yeah.
quite a spectacle. And for
Yeah.
context, I think an NVIDIA chip might be the size of like your pinky nail, right?
Well,
So
real quick, I just mentioned, because I have a background in physics, you sort of reach the limits with these chips in terms of distance because of the speed of light, believe it or not. Part of it. That's why they want to put it all on one chip.
Yeah,
It's
we've
amazing.
actually made an investment recently in a company that's going right after that exact problem. We're happy to talk about that too as well. But yeah, with Cerebras, right? They really knew that they were building for a future that hadn't quite arrived yet. They had a ton of conviction, a great team that had worked together previously and sold a company together in this space, which gave them a lot of credibility together. And I think fast forward to today, 4 years later, they've clearly been proven right through some of the partnerships that they've been able to establish and kind of the growth of AI that they foresaw even before, these public signals started being provided to the market. So I think that's another one that we're really excited about. Recently filed their prospectus to, go public sometime in the very near future. So we're excited to kind of see how that goes and think they'll do very well.
So I guess you've gone through the questions we had here.
Well, then I would like to ask a question in
Very good.
addition. And that is the recent news that came out over the weekend. It's the beginning of May, and they're actually advisors of SpaceX are pushing for faster inclusion in the indexes. And
Oh, yeah.
just for our clients to know this, generally the indexes have always had these rules that when a company did release, did do an IPO, there was a certain amount of time that had to go transpire before they actually were able to join an index. And SpaceX is trying, or the advisors of SpaceX are trying to accelerate that. Can you say a little bit about that?
Yeah, JP, you want to jump in there? I can take it.
Sure. So yeah, look, I think what's really interesting about SpaceX in general is just, right, this is slated to be, should they follow suit on this IPO, which is what we're all seeing here in the news, the largest IPO in the history of financial markets, right? It's going to surpass Saudi Aramco's as the previous largest IPO. So therefore, I think what a lot of the indices are doing that are smart to absorb this large IPO here is, for the NASDAQ 100, they have now created an expedited approval for SpaceX, which I believe is at 15 days post IPO. And what the S&P 500 is now doing is they're changing that approval to the index from 1 year to 6 months. So what you're seeing is typically a company that goes public is usually locked up in the public markets anywhere between 4 to 6 months. And we'll see how the lockup parameters are for SpaceX because it, again, is such a unique company and it's going to be the largest IPO in history. That it's, a lot of these indices are doing a lot of everything they can to really successfully absorb this size of an IPO. I think that's really important to hit on, and you're going to create a lot of passive flows, right? Any exchange traded fund, any mutual fund that closely tracks the NASDAQ or the S&P 500 will create a lot of passive flows into this name that should also support, this issuance. So, David, I don't know if you want to add anything to that, but I think that's what's really good.
I just wonder how much of the S&P 500 it would represent based on the potential size of the IPO,
Yeah.
Well,
Yeah.
it might create a more concentrated position again.
Yeah.
But
I think, JP kind of nailed it. And, to your point too about the concentration, yeah, it's a large position. It will definitely be an interesting thing to manage that we will be doing for the first time alongside everybody who's kind of, experiencing something of this magnitude. I think, one thing that I think is important to kind of draw to is while these changes are being proposed for SpaceX, there's a lot of very large IPOs that are in the rumor mill for the rest of this year. Maybe not quite to the same scale there, but still very large relative to what most people would think of when they think of an IPO, and even relative to many of the names in our book that have gone out recently. These are still orders of magnitude larger businesses, and so while they're being done to accommodate the obvious need for SpaceX, I think a lot of these changes do bode well for some of those other tiers 2 of large IPOs, whether it be, the OpenAIs and Anthropics, or a company like Databricks, which is also already a multi-$100 million enterprise value company, to be able to get into the index early on, provide a lot of passive flows to support these names. And, one of the things with exit activity is you want to see good outcomes happen in order for more outcomes to keep coming. And so if we can see, positive reception through some of these changes for these large companies that are kind of first on the docket to go out, we think it can have a really positive kind of carryover effect to the rest of the market, who's kind of been clamoring to get liquidity for a while now, and that can be a good way to recycle capital back into private markets and continue to move things along. So we're excited about it all.
yeah, thanks for the clarification. I was wondering whether this was considered a one-off accommodation or whether this was considered something that might be much more broader. And so very, very interesting. And, from the standpoint of exiting, just so that our clients understand, your general approach is that when a company does do an IPO, at the time where it's right, where you're able to, you usually do exit. You don't usually carry that publicly traded stock in your portfolio.
That's right. Yeah, we so normally in a traditional IPO, we'll incur a 6-month lockup period where we're prohibited from selling any of the shares that we own. Once that period is over, we then look to get out of our position over maybe a 3 to 6 month period after that. The main
Right.
thing that's going to determine how quickly we do that is really just the strength of the market for the name.
Right.
Obviously, if things are really strong and the market is continuing to go up and to the right, we want to take advantage of that and kind of sell our position into that strength. If, like in many cases, there's a lot of people looking to sell right when lockup gets over, whether it's funds or employees or whoever, just to
Right.
generate some liquidity.
Right.
There may be a period where that stock trades down a bit right when the lockup is over. We would never just immediately dump into a weak market. We want to hold and make sure that we're selling, when the prices are more favorable to us. But yeah, generally speaking, we are not holding on to public positions, even if it would make us a lot more money, and even if we think they're great names, it's not our mandate to charge a management fee on public names, and so we plan to get out of those as kind of soon as practicable.
Okay.
Great.
Wonderful. Thank you.
Yep.
So, David and JP, this has been incredibly helpful. Understanding structure, access, and intention is really important when incorporating private investments. And so, thank you for walking us through all of this and the discipline that you incur. And thank you for everyone else that's listening. For our clients, please let us know if you'd like to discuss anything about this conversation or how this investment is actually part of your overall portfolio and our overall strategy. So thanks again. Hope to see everyone soon. Bye.
Thank you, guys.
Thank you.